Hi, good afternoon, everyone. Thank you so much for taking the time out of your day to attend today's session, where we will look to tackle a really essential topic, which is building a secure and financial fulfilling future. So, just to give you a little introduction on who we are, your speakers. So, my name is Umarrah. I'm a UK qualified chartered financial advisor, and my passion lies with supporting and empowering individuals, families, business owners on their financial journey. So I've advised in the UK, and I'm now doing the same here in the region for expats.
My name is Rhiannon. I'm also a UK qualified financial planner with a similar background to Umarrah. I have just over 12 years of experience financial planning now back in the UK, and I moved over to Dubai with my family about a year ago. And my focus again is on providing financial planning and advice to individuals and their families here in the region.
Right, so today's session is all about you. So together, what we will aim to do is explore the core pillars of financial planning, which are budgeting, protection, investing, and estate planning. We will then have an opportunity at the end to run through any questions. So please feel free to add them into the chat box as they come up. And also throughout the session, you will notice some QR codes on the screens. So we've just kind of got those there. So if we're covering any specific topics and you're thinking, right, I really need to get on that, and just scan the QR code and it'll take you to our WhatsApp, where you can again ask some more personal questions or book in a time to speak with Rhea or I.
Okay then, so before we get into the specifics, let's just have a quick think about why financial planning is so important. It's important for a number of reasons, isn't it? I mean, it helps you to take control of your money, first of all. It will help you to manage risks. And finally, financial planning will ensure that you're on track to achieve whatever your life goals and aspirations are. That might be saving for investment, buying a house, preparing for unexpected expenses. Doesn't matter, but having that plan in place will make the world of difference. And having this plan in place, this financial plan, will also help to ensure that you've got financial security. Now, financial security is quite a broad term and it means different things to different people. But for us as financial planners, financial security means having the ability to meet your current and future needs without constant stress or worry. It means having the freedom to make choices that align with your career aspirations and your ideal lifestyle. And I think most importantly, financial security provides peace of mind, doesn't it? It gives you the confidence that you can handle life surprises, whether they're challenges or indeed opportunities. And the starting point for putting your financial plan together is to make sure that we've got the basics covered first. And that means establishing a solid foundation that we can then build on. So this foundation includes looking at things like your budget, your emergency fund, life cover, and wills.
Okay, so let's dive into the first foundation, one of the most important building blocks of your financial success. And this is budgeting and an emergency fund. So if you think of budgeting like the solid foundation of your financial house, because without it, it's nearly impossible to build anything stable or lasting on top. Now, by understanding where your money is coming from and where it's going, you can identify opportunities to optimize your cash flow. Regular reviews really help stay on top of your income streams and avoid any unnecessary stress. Now, Rhea and I do tend to sit with our clients and run through their outgoings for the last couple of months. And it's a really useful exercise, which I urge you all to do, because it helps highlight any unnecessary spending or anywhere that you can optimize your spending. And ultimately, it then helps you maybe redirect more to saving for the future. And one of the tools that we find a lot of our clients find very useful is the 50-30-20 rule. 50% is allocated towards your essential spending. So, things like your rent, your food, your mortgage, etc. 30% on your social and leisure, because that's super important also. And then you've got your 20%, which we say try and allocate that to your planning for your future. And again, it's just rough guidelines. It's not always going to break up like that, 50, 30, 20, but just having a rough guide just helps you plan. And once you have that, then the next step, which is really important to work on, is your emergency fund. Now, if you view that as your financial safety net, it's like a parachute, right? So we hope that you'll never need to use it, but if you do, it can really save you from a financial free fall. We typically recommend our clients have 3 to 6 months of their essential expenditure. So if you all, I guess, just take a minute and imagine what would that feel like if you had 6 months of your essential spending saved in a bank account that was earmarked away, it's instantly accessible. If anything was to come up, any unexpected expenses, you know you have the money there to cover that. The confidence that that brings is really, really powerful.
Okay, so that's the first pillar. The second pillar for your financial foundation is protection. And I'm going to spend just a few minutes now talking about protection. My goal here is just to dispel a couple of myths and really get you thinking about whether this is an area that needs some attention. So to start off then, what do we actually mean by protection? Well, quite simply, we mean health cover, life cover, and critical illness cover. Now, in this part of the world, having health cover in place is mandatory. We know that. We know that if you get sick, then you'll have access to the medical care and the treatment that you need. But do you have life cover and do you have critical illness cover in place? So let's spend just a couple of minutes looking at these in a bit more detail and have a look at why we might actually need them. So we'll start off first of all with life cover. Now, I'm sure that many people watching this webinar are already aware of what life cover is. It's a policy that pays out a lump sum in the event of death. And this can be used by your loved ones in a number of different ways. Initially, many people associate having life cover with some kind of a debt. So, for example, we'll take life cover out at the same time that we take out a mortgage, so that if we die, the policy pays out a lump sum and the mortgage is cleared. But there are other uses for life cover. And one of the key ways that we use it with clients is to generate an income that can then be used to pay bills and living expenses for your family. So if your partner, your husband, your wife, your children can't cope financially without you, then you need to be thinking about putting life cover in place. And then next up, we've got critical illness insurance. This one is really important. And in our experience, it's often not thought about, certainly in this part of the world, because so many people think, well, I've got health cover in place. I don't need critical illness cover too. But actually, that's not necessarily the case. So if we think about what the difference between health cover and critical illness cover is, health insurance, we covered that a minute ago. It pays medical expenses when we're ill. Critical illness cover, on the other hand, pays a lump sum to you when you're diagnosed with a serious illness. And this lump sum can be used by you in many different ways. So firstly, it might be that all the treatments that you require to treat your illness are not necessarily covered by your health insurance, or you may opt to have extra treatments and you may need the money to put towards. But it's also very likely that if you've been diagnosed with a serious illness, that you're going to need to take some time off work. So you can use the lump sum from the policy to cover your living expenses. So that means paying the mortgage or the rent, paying the bills, caring for your family while you're off work and recovering. And that in turn reduces financial stress so that you can focus on getting better. Now, living here in the UAE comes with many advantages. We've got great weather, it's safe, and we're earning in a tax-free environment. But it does also mean that we don't have access to the safety nets that many of us are used to back in our home countries. So if something happens to you, your family won't automatically receive financial assistance. And that means that having your own safety net in the form of insurance isn't just a nice to have, it's a necessity. Now, we hope that our clients never have to claim on these types of policies, but the fact is we can't predict the future. We can, however, plan for it, and that means planning for worst case scenario whilst hoping for the best. So if you've not got your life or your critical illness cover in place yet, or you do have a policy, but you're not quite sure whether it's the right fit, if you scan the QR code that you'll see on the screen, then we'll be more than happy to help. As Umarrah said before, the QR code links to our WhatsApp. So if you'd like any more information on any of the things that we're talking about, or if you'd like to book a meeting with one of us, just send us a message and we'll be happy to help.
Okay, perfect. So let's dive into another topic, which is often overlooked, but it's incredibly important, which is estate planning. Now, in the UAE, there are specific inheritance laws that makes it essential to have a plan in place to ensure that your wishes are honored. Now, a will, it's not just about your assets, it's about protecting your loved ones and ensuring that your legacy is handled according to your wishes. For those of you who have children, it becomes even more critical because, again, in the UAE, there are certain laws in terms of if something was to happen to you or your partner, who would get guardianship for your child. And essentially, again, with the will, distribution of your assets upon your death would be divided according to Sharia law. So that means there would be specific percentages that would go to specific beneficiaries. Your accounts may be frozen while your estate is being distributed, which again then adds that more financial stress to your family. So even though, thinking about a will or a guardianship or creating a will and guardianship can feel really complex, it's super, super important. So you have that peace of mind that my future, my legacy, my family is all going to be secure, financially secure. So again, if that's not something that you have in place, we really, really advise it's something that you look into as soon as possible. And again, we're happy to have those discussions with you.
Okay, so now we've covered all the basics and we've made sure we've got our financial stability. That means that we can look ahead to the future. And this is where financial planning becomes much more exciting because it's about looking ahead, thinking about the future and aligning our goals with a clear financial plan to help you achieve them. So think about, where do you want to be in 5, 10 or 20 years' time, or even beyond? In order for us to plan properly, we need to know exactly what it is you want to achieve and when. So spending some time setting your goals will provide you with direction, motivation, and a sense of purpose. Having goals gives you focus, and without them, it's very easy to drift through life without making meaningful progress. So, for example, if family is your priority, then your plan might focus on financial security and saving for education. If travel is your passion, then you could dedicate meaningful savings to meaningful experiences and adventures. And if you want to achieve financial independence, then saving and investing consistently can give you the ability to earn a passive income in the future. So just take a moment to think about what really matters to you. What is it that you want to achieve in 5, 10 or 20 years? Our clients come to us with many different types of goals and aspirations. And ultimately, it doesn't matter what your goals are. What we need to do is put a financial plan in place to help you achieve them. The most common goals that we find our clients come to us with are, for example, making money in the bank work harder for you, or saving a house deposit. And really important ones that many people are focused on at the moment are accumulating pots of money that can then be used in the future to generate a passive income or to enable you to retire one day.
Okay, so I'm sure that you all have your own personal or financial goals. You've thought about them, it's where you want to see yourself in future. But then the question arises, okay, so how do I turn that into reality? How do I get there? And the short answer is you invest. Now, investing, it's about making your money work as hard as you do, and helping you bridge that gap between where you are now and where you want to be in the future. It is one of the best ways to build wealth over time, but it can seem really, really, really overwhelming, especially if it's something you've not done before or you're just starting out. So what Rhea and I would like to just spend the second half of the session on is just breaking that down to explore some of the different things that we do factor in when investing. So, why is it important? Things like asset classes, levels of risk, the cost of delaying doing anything. And when we're looking at these examples, what we'll look at is some of the more common examples of goals that we see with our clients. So I guess the two most common ones that we see are our clients looking to save to purchase a property. And then a really important one is clients looking to save for their retirement. Typically, both have completely different time horizons, so that's kind of what we'll look at doing.
Okay then, yeah. So starting off with time horizon then. Time horizon basically means how long do you plan to keep your money invested before you need to use it? And this is really important. So if you think about the two goals that Umarrah said we're going to consider, the first one is saving to purchase a house. So if we're saving a deposit for a property purchase, let's say that that's a short-term goal and we want to achieve this deposit within the next 5 years. But our retirement goal, on the other hand, is a long-term goal, and that has a long time horizon. So let's just assume that that's going to be a 25 to 30-year time horizon. Now, this is really important because your time horizon, the amount of time that you plan to keep your money invested, will dictate to some extent the level of risk that you then want to take with your money. So let's just think about risk then. What do we actually mean by risk when we're talking about money? Risk is a huge topic and it means lots of different things to lots of different people depending on what they're planning to do. But the most immediate risk that many clients think about when we start talking about this topic is the risk of loss. What is the risk of me losing the money that I invest? Or what's the risk that the investment doesn't perform as well as we expect it to? Now, people generally tend to feel the pain of a loss twice as strongly as they feel the pleasure of a gain. And there's been a lot of research into this. This is called loss aversion. And this fear of loss, this fear of losing money, leads many people to doing nothing. But doing nothing and leaving your money in the bank is also a risk. So what kind of risk is this?
So, inflation. Inflation is when the prices of things we buy, so food, rent, clothes, etc., gradually go up over time, which we've all experienced. What does that mean? It means that your money doesn't stretch as far as it once used to. Now, a lot of clients that we tend to speak to, they save for their goals by keeping money in cash, which is completely suitable if you need the money in the next year. But for that house deposit, for example, that you need in 5 years, not so much. So I've got an example here on the screen. So you've got $20,000, you're putting it into a savings account, it's got 2% interest. So you think, okay, my money's safe, I'm earning 2% interest every year, I'm happy with that, that's fine. After 5 years, you think, okay, it'll be sitting at around £22,081. That's perfect. But one thing that a lot of people don't take into consideration here is the rate of inflation. So let's just say there's been a rate of inflation at 3%. The real term of that $20,000 that you've put in is approximately now only worth just over $19,000 in today's money. So what that means is, yes, just you've earned your interest, but your money is still losing value over time due to inflation. So again, you think, okay, my money's safe, it's risk-free. And we come across a lot of clients who keep a lot of money in cash because of that. But again, what they don't fully understand is that you are still risking losing your money because you're exposing your money to the risk of inflation.
And as I said before, risk is a really big topic. There are lots of different types of risks that people need to think about. So we've just heard from Umarrah that we've got inflation risk if our money is sat in the bank. Many people that we find here in this region, this part of the world, will send money back home or even bring it over to Dubai. So in that situation, we've got currency risk. This actually is a risk that we're exposed to because my husband, he still earns in sterling. And so he brings his drawings over to Dubai every month. And in recent months, the exchange rate has gone down. So he's earning the same income, but he's actually bringing home less money each month because of the exchange rates. That's a risk to our income. A lot of our clients like to invest in property as well. It's a good way of diversifying an overall investment strategy. But there are risks associated with investing in property. One of the key ones here is what we call liquidity risk. So how accessible is the money? What if you've invested all your money into property and you need to then get your hands on some cash? What are the chances of you being able to get your money back out of the property at any speed? And the other thing is, if you tied a lot of money up in property, you've potentially got the risk of having all of your eggs in one basket.
Now, I'm sure that's a phrase that you've heard a lot. But what do we mean in terms of having all of your eggs in one basket when it comes to investments? So you'll see on the screen here, we've got kind of a colored quilted chart. Each color represents different asset classes. So on the left-hand side from bottom to top, we've got worst performing till best performing. And then from left to right, we've got the years. Essentially, all this is showing you, even if you just kind of look at the colors, is that there is not one year that each asset class is consistently performing at its best or performing at its worst. It changes over time. And that's why it is really important, as Rhi said, that you are diversifying between your assets. Because imagine, for example, you've put all of your retirement into one stock. The company's doing well, so that's great. But let's just say it gets to the time you're looking to retire and that company has had a really bad year. Obviously, the value of your retirement fund, it's not going to look as healthy as it once did. And you're then not going to have other asset classes that can balance that out. So that's why it's really important. Try and spread your investments as much as you can across kind of stocks, bonds, real estate, and even kind of globally diversifying across different countries, sectors, etc. Because it's reducing the overall risk that you're taking, and it's also helping your money, protect your money, from any extreme market swings as well.
So I think the point that we've been making throughout the whole of this section is it doesn't matter where you put your money. You will be taking some form of risk. Inflation risk if your money's sat in the bank, liquidity risk if it's all tied up in property. We've got market risk, the extent to which your investments go up and down, and we mentioned before currency risk, the risk of fluctuations in exchange rates. So there are loads and loads of different types of risks, but the key is, do you understand the risk and do you accept that risk? Because the idea isn't to avoid it, but instead to manage risk by assessing your attitude. So what level of risk are you comfortable in taking for each of your goals? And your attitude to risk may well vary between each of your goals and your time horizon for each goal. So we said before, we're going to be thinking about our short-term goal of wanting to save a house deposit within the next few years and our long-term goal of wanting to save for retirement in 25 or 30 years' time. So thinking about our house deposit then, we've got here a short time horizon. So if you look at the slide that's on screen now, we've got a risk scale and it goes from lowest risk at one end to the highest risk at the other end. If we're wanting to save to purchase a property within the next few years, we're going to find ourselves at the lower end of the risk scale. We're going to want to play it more cautiously with our money because we've got a short time horizon. So if the market falls in value, we might not have the time that we need to make sure that the markets recover. So we need to play it more safely with our money. On the other hand, if we're saving for retirement in 25 or 30 years' time, then we can take a much higher level of risk. We may find ourselves up at the adventurous or even extremely adventurous end of the risk scale. And the reason that we can do this is because we've now got time on our side, time to ride out fluctuations in the markets. We can afford to withstand the short-term volatility for the sake of achieving the long-term growth. The biggest risk, what is the biggest risk that you can take with your money? Well, quite simply, the biggest risk you can take with your money is doing nothing. But many of our clients say to us at this point, well, I haven't actually got enough money to make a difference. But we know that even small changes can make really big differences. So I'm sure there are many people here today who like to treat themselves to the odd cup of coffee or the odd croissant. And in fact, there are actually many people that do this every day. And over the course of your working life, those few dollars a day can really add up. So imagine now, instead of buying that cup of coffee for yourself, you invested those few dollars into the US markets. And you do this every day over the course of your working life. Now, the figures are quite surprising actually. Based on actual historical performance, by the time you retire, if you'd invested those few dollars a day instead of buying yourself a cup of coffee, you could actually have grown an investment pot of $830,000. Now, We're not saying that you should miss out on life's pleasures. And yes, this is a bit of an extreme example. But this example illustrates the fact that small changes and consistent intentional actions can have over time. So if you think about our goal of wanting to retire in 25 years, just imagine having an extra $830,000 in your retirement pot simply just by redirecting the money that you're already spending. There's no extra effort on your part. It's not costing you anymore. It's just a small shift with a really big impact. And you get this big impact thanks to the power of compounding. Now, you may well have heard this before, but Albert Einstein famously called compound returns the eighth wonder of the world. Now, what is compounding then? Well, basically, it's when your money earns a return, and then that return starts earning its own return as well. And over time, what started as something really small grows faster and faster, and your investment grows bigger and bigger. Now, I've got a couple of examples coming up that will illustrate the power of compounding. So we're going to start off, first of all, with an investment of $25,000. And we've invested this money and it's achieving a 7% return each year. Now, in the first year, you'll generate a profit of $1,750. In the second year, you'll earn a return not just on the original $25,000 you invested, but also on the $1,750 that you generated in year one. The same thing will happen the year after that, the year after that, the year after that, and this goes on and on and on. And after 10 years, your investment's worth $49,000, and after 20 years, it's worth $96,000. But bear in mind with this example, you haven't added to this pot. You've invested your money, $25,000 on day one, and then you've left it alone and let the money work hard for you. So with compounding, time is your greatest ally. So we've got another example coming up now. So let's think about our goal of saving for retirement, okay? This is our long-term goal. So imagine that you are currently 30 years old and you've decided that you want to retire at the age of 60, okay? So we've got a long time horizon. That means we can take a higher level of risk. And we're going to assume a return of 7% per annum. When you retire, you want to have an income coming in of $3,000 each and every month. So in order to do this, in order to achieve that goal, you're going to now need to invest $830 a month. But you think to yourself, well, I'm only 30, retirement's ages away. So you put it off, you enjoy your 30s. And then by the time your 40th birthday comes around, you start thinking, probably need to start planning for the future. I'm going to think about my retirement again. You still want to retire at 60. You still want an income of $3,000 a month. But now you'll actually need to invest $1,500 each and every month. Okay? That's a huge difference. And we call this the cost of delay. Okay? So when's the best time to start investing? Yesterday. And the second best time to start investing is today. So when it comes to your long-term goals like retirement, yes, they may well seem very far away, but the sooner you start doing something about them, the easier they are to achieve because you've got longer to make your money work hard for you.
Okay. Now when it comes to investing, it's really important that you don't have the mindset of, okay, it's set up and forget it strategy. And a one-size-fits-all approach, it simply does not work because your strategy, it needs to be as unique as you and your situation and your circumstances. Now, your financial goals will ultimately change over time. Your risk tolerance, market conditions also change over time, which is why regular reviews are really, really, really important. Because it's really important that anything that we're setting up evolves with you, and having a solid review process is key to making that plan a success. What I would like to do is just highlight that with an example, just to kind of really bring it to life on the consequences of not regularly reviewing your plan and the effect that that can have. So if we look at an example of a client of ours, we'll call her Jane. She came to me a couple of years ago with a clear plan. She hadn't reviewed it, however, though. So the plan was put in place. Some life insurance was set up, some investments were set up for her long term. It hadn't been reviewed for a while because she thought, I don't want to review my plan. I'm set up, I'm happy, don't need to review it. But since she had initially set up her plan, she had a significant promotion. She bought a larger, more expensive property, and she also started a family. So over time, naturally, her financial priorities shifted. By the time she came to us for a checkup, it was very apparent that her investments, her savings, and her insurance no longer remained fit for her circumstances. She'd missed out on opportunities to grow her wealth more effectively, especially when it came to planning and saving for her children's future education. Her retirement and her insurance policies also did not cover her new mortgage, for example, or the family's needs any longer. Now, had she met with a advisor more regularly, she could have made those adjustments. She could have topped up her life insurance and updated it so it fit her new mortgage, so it fit covering her family. And also, you know, she'd had a promotion, so start earning more, therefore saving more towards her future. So that's why it's really, really important. Ensure once you have taken that step to set up your financial plan, make sure you're regularly reviewing it. I mean, Rhea and I sit down at a minimum 6 to 12 months every year just to have a chat, review your circumstances, review your goals, and like I said, review the markets and just make any necessary adjustments. And this way it means you're not just reacting, you're being more proactive with your plan as well. And it just helps you keep you on course. And also just gives you that peace of mind that you're financially secure and you're on track. Because I'm sure we're all aware, you know, life, it's full of unexpected events, whether that's new jobs, growing your families, and like I said, even kind of factors that are not within our control, like market changes. So it's really important that you do stay in contact with your regular financial advisor, and just make sure that your plan continuously changes with your life.
Okay then, so here at Skybound, we believe that financial planning isn't just about numbers. It's about creating the life that you want, and we're here to help you achieve financial freedom in a number of different ways. So firstly, we offer personalised financial planning. We understand that everybody's journey is different, and that's why we offer strategies that are tailored to your specific circumstances, and that's whether you're focused on ensuring that your loved ones are protected, building wealth and making your money work hard for you, generating a passive income, or saving for retirement. Doesn't matter what your goals are, we will craft a plan that helps to fit your life and your aspirations. But if you don't quite feel ready to dive into full financial planning just yet, then you might find that financial coaching is the perfect first step because it provides a solid foundation for understanding and managing your finances. So, through financial coaching, we'll work together on the foundations of your finances to help you create a budget that reflects your lifestyle. We'll help you to analyse your cash flow so that you can understand where your money's going and identify opportunities to save. We can also help you to develop a plan to reduce or eliminate debt, whilst also balancing other financial needs. And of course, help you to build an emergency fund to ensure that you've got that safety net for those unexpected expenses. But most importantly, financial coaching will help you to build confidence with your money. It helps you to lay the groundwork for future financial success, and it ensures that you're in a strong position when you are ready to take the next step into comprehensive financial planning. In addition to this, Umarrah and I also run a dedicated network, which is called Women Like Us. And this focuses on financial planning and education specifically for women.
Perfect. So again, thank you everyone so much for attending. Just while I'm wrapping up, in the meantime, if anyone has any questions, there is a Q&A box, so please feel free to pop them in. So while you're doing that, if anyone does have any questions, I would just like to say, planning for your and your family's financial secure future, of course, it's on the top of all of our priority lists. But I know it can feel really overwhelming and time consuming, and you think, I do need to get to that. But before you know it, especially here in the UAE, we know how quickly time goes. Time passes, your goals feel more distant. So, you know, as we've had a look at what the cost of delay looks like and how important it is to start as early as possible. So whether it's, you know, you're wanting to discuss growing your wealth, protecting your family, or even just getting a clear financial plan in place, or even if you do have a financial plan, just having a review of that plan. Rhea and I would love to have a conversation with you, and help you just kind of get on top of that. So again, QR code at the bottom of the screen, please feel free to scan it. If you have any personal questions you would like to ask or just book in a meeting, please feel free to do that, and we would love to hear from you. But again, thank you so much for attending, and enjoy the rest of your evening.